So here is the meeting outline for number 7, the conference call. Today, we're going to talk about a tactic to prevent takeovers. It's called the poison pill. It's a very interesting topic. I've kind of experienced it a little bit with stock I'm in right now, EFSH. Now, we don't know for sure if they did use a poison pill, but it is a possibility that they continue to dilute their stock to stop people from gaining too much control of the company. We're going to talk about the consolidated CEI VKIN valuation after the reverse merger. And we're going to talk about the James Doris interview notes that I took after rewatching my interview with him. If you have not seen that interview yet with James Doris and myself this past Tuesday, I highly suggest that you watch it. It was very informative. There was a lot of things that we went over and a lot of good nuggets. We're going to go over, as usual, the D.A.T.A capital dividend portfolio. We're going to see the full scale, talk about the top 2 performers, the bottom 2 performers, any honorable mentions, and then we're going to get into the 2 showcases. We're going to talk about Realty Income Corporation, the status of the real estate market with higher rates, and how that affects that company, even though it's not a housing real estate stock. It's more of a commercialized, single standing real estate stock, 7-Elevens, Walgreens, dollar stores. And then we're going to go into ANDE, the Andersons Incorporated. It's an agricultural stock, grain, fertilizer, feed, that type of thing, corn. And so we're going to talk about agriculture and food stocks weathering this recession storm. So that's what we have on the docket today for the meeting outline. Again, if you have any questions, just let me know in the comment section, and I'll try to get to them. But like what I usually do, I like to record these, and then I'll piecemeal these out into separate videos on my other Gematria stocks account. So make sure you give a subscribe to that. Like the video, subscribe, and do all those things as we keep growing. All right. So to first start off, tactic to prevent takeovers, the poison pill, right? So we have the poison pill. A poison pill is a defense strategy used by the directors of a public company to prevent activist investors, competitors, or other would-be acquirers to take control of the company. Poison pills are executed by buying up large amounts of its stock. These effectively block the accumulation of a company's outstanding shares. Companies promise to distribute additional free or heavily discounted shares to all existing shareholders, which dilutes the shares so outsiders can't take over the company by purchasing a controlling amount of shares. So you'll see that with offerings and whatnot, especially on lower float companies. So if somebody comes in on a low float and buys a lot of shares, especially in a penny stock, the board members of the company might see that as a threat because they don't want to lose controlling power of their own company. So they might run extra offerings, which in turn lessens the value of the stock price. But they at least are able to keep control because it keeps that accumulator under the controlling threshold. The poison pill tactic has been around since the 1980s. It was when it was devised by a New York law firm, Wachtell, Lipton, Rosen, and Katz, amid a wave of hostile takeovers and greenmail attempts by corporate raiders since rebranded as activist investors. All right. The courts have ruled that poison pills are a legitimate defense against such attempts to circumvent a company's board's prerogatives. It's just a defense mechanism. So the people in current power, the CEOs, the board directors, the founders can keep control without someone coming in, having different ideals, trying to change things around. Now, that's not necessarily saying that's a good thing or a bad thing. It's just a tactic used in stock market, strategy, warfare, the game itself. And so there were some examples of poison pills in the past, in the last couple of years. Twitter, X, there was a poison pill put on because Elon Musk was, eventually he bought out the company, but they just started to dilute the company so it wouldn't happen when it was going to. Papa John's happened in 2018. The founder, the founder of the company, John, he had 30% of the company already locked up, but he was trying to take over more control. Now, he wasn't in a controlling position with that 30%, but the board of directors said, if you go over your threshold of 30%, we will dilute the stock. And, he didn't want to do that to himself because that lessens the stock price value. Same thing happened with Netflix in 2012. So it does happen pretty frequently. If somebody tries to come in and change things around, the board of directors, the CEO might say, hey, that's not going to happen. Now, in regards to some Gematria, it's very interesting because there's a lot of money numbers that pop up for this. The poison pill equals 137 in English ordinal. We know the importance of 137, the 33rd prime. We have 56 in the reduction cipher. We have 133 in the reverse ordinal, and we have 52 in reverse reduction. So across the board, very powerful numbers. The 137, the 56, the 133, the 52. In a lot of cases, a lot of money numbers, a lot of control numbers. The poison pill at the bottom, some more Gematria. The poison pill, legal in Delaware, equals 137 in English reduction. Now, there's a lot of companies that are incorporated in Delaware due to their specific specific business rules and legalities. A little bit more flexible, and the tax codes are a little bit different. So if you notice, a lot of corporations are incorporated in Delaware for reasons like the poison pill and other things. A poison pill in the stock market gets used to stop takeover attempts from unwanted investors equals 330 in English reduction. The NY law firm of Watchell, Lipton, Rosen, and Katz were the founders of poison pill equals 333 English reduction. So you see the power right there. When they came up with this idea in the 80s, it changed the game. So that's why you have that 333 there, very powerful. And another 333 in reduction. Poison pills in stock market hurt float and prevent takeover attempts by unwanted investors. 333 English reduction. Again, highly important. If you have a company that you started, and when you go into the public markets, you're selling shares of that company, so it's not totally yours anymore. You just have a percentage. But if you want to keep that controlling percentage, you might have to use a poison pill if someone tries to take in and what you started. So again, very common defense stratagem by companies to protect themselves. So let's get into the combined financials of CEI and VKIN. Now, this is very interesting. It took a while for the merger to happen, the reverse merger to happen, but it's finally here. These are the pro forma financials that CEI dropped, about 2 weeks ago. And now with CEI and VKIN combined, the company is looking a lot more healthy. Now, we still need to get our revenues up. We still have to sell our technology and products and whatnot, but the assets are up, liabilities are down, and we're just at a better position, especially on the New York Stock Exchange with the Amex. We finally, from what I'm hearing, we are finally on the equity, like we finally are within the equity requirements, so we can stay on the exchange. So that's very huge. Looking at the financials, we have 90 million in assets. The liabilities, 75.9 million. So that's net equity of 14.1 million. Our revenues at 14.4 million. Operating costs at negative 20.5 million. So there's an income loss from operations of about 6 million, 6.1 million. Now, for a growth company like this is, that's not bad at all. There's a lot other companies out there that trade in at much higher multiples, very overvalued, that have higher income losses than what CEI currently has. So what James has been doing, lowering the debt, getting those assets under one roof, keeping the liabilities low when necessary, that's very positive moving forward. The shares outstanding right now, we understand that the preferred C shares could change things. We don't know how many preferred C shares are left in regards to common shares, but I know there's not a whole lot left. But right now, on most exchanges, we are sitting at 88.45 million for our float. Now we're talking about a net equity fair value. I like to use this valuation because it's very conservative. It doesn't really take in revenues. It doesn't take in growth prospects. It's literally assets minus liabilities over the shares outstanding. And that I use that because, say, if the company goes bankrupt and someone needs to buy out the company, what's the company worth base value? Very conservative, especially when we're in a bear market. We don't know what can happen. Obviously, there's other ways to evaluate things, and we'll get into that when they start selling product. But right now, we're just being conservative and staying at the baseline. And so right now, the net equity fair value, when you take that 4.1 million in net equity divided by the 88.45 million, we're sorry about that, guys. For some reason, the live stream ended while I was presenting. I was on the call, so there was no reason for them to drop the call. Anyways, we'll finish up what we've been going through, and then we'll go along with our day. So where I was at, net equity fair value for CEI, it's going to be 14.1 million divided by 88.45 million, which is about 15 cents, almost 16 cents. Now on NYSE Amex, you need 20-cent threshold to be trading above so you don't receive a delisting notice. Now, hopefully we stay above that 20-cent mark due to our equity requirements that we fulfilled now with the reverse merger. So hopefully we don't have that issue. But it's nice to see that fair value wise, just based off assets and liabilities, we're really close to that 20-cent threshold, and not like we were before with all those derivative shares, which hurt us, and which why we needed to have that reverse split. Now, there's a valuation I sometimes like to use. It's when you exclude long-term debt. All right, when you exclude long-term debt. And so when you think about excluding long-term debt, think about how with long-term debt, you don't have to pay that within that current year or 12 months. So you just keep kicking it down the road. You only pay the debt that you need to pay within that year. So that works with the current liabilities, right? And so what it is called when you see it in SEC filings and whatnot is the current portion of long-term debt, CPLTD, refers to the section of a company's balance sheet that records the total amount of long-term debt that must be paid within the current year. Right now for CEI, so the long-term debt net of current portion and debt discount is 37.56 million. That does not need to be paid in the current year. So think about this. When you take the total liabilities of 75.9 million minus the LTD NCP of 37.56 million, that leaves only 38.4 million in liabilities that we have to currently really account for. And so take the 90 million of assets minus that 38.4 million of liabilities. Now we're looking at 51.6 million in net equity. So now we're at a higher point when we're currently looking at the stock. And so 51.6 million divided by 88.45 million equals about 58 cents. So you see the discrepancy. The price right now of CEI is about 30 cents. So it's almost double when you don't account for the long-term debt that we don't have to pay for the rest of the year. And so when you take that first net equity equation where we're sitting at almost 16 cents, you see we're kind of right in the middle. The market is kind of, in my opinion, adjusting it almost correctly now. Being that the preferred shares are almost done, I think the market's finally figuring out how to value CEI before the revenue starts to kick up. And just for Gematria purposes, long-term debts, net of current portion of long-term debt is not in the present year 333 in English reduction. Now getting into the James Doris CEI interview notes after rewatching, I just have some bullet points that I took notes on when I rewatched it, because when I was doing the interview with James, I was more worried about keeping it smooth, making sure everything is going correctly. But when I rewatched it, I was able to pick up a lot more things, knowing that he's not really allowed to say specific things because it can't it can't move the stock price in any way. So you have to read between the lines, and I think I got a lot of good information that we were able to. So these are some of the notes. Commercialization of product line is key focus now moving forward. We're in the commercial line now. We're trying to make money, right? So we're trying to finally make money. James wants 100% ownership of each branch of business when the timing's right. 60% of Simpson Maxwell right now, 51% of the ozone and grid technology. And so, someone in the comment section fact check me if that's not correct. I think that's what the ownership is right now with those two lines of business. James believes each division can stand on its own, possible spin-offs down the road. ESG carbon capture Holyoke team told James it should be complete in October. Things change. Don't hold your breath. But that's what they told James. Obviously, they could come back and say, hey, it's going to be a little while. But they said October, the Holyoke operation should be good to go. The Reno plant should be operational very soon. No official timetable. He says it's a first-class operation, has opportunity to bring in government subsidies. Other people's money is always better, obviously. Would make equity payment of transaction more palatable, in my opinion, if we do get some of that government funding. We always like government money. Look at Tesla. I mean, they've been funded by the government. That's the only reason why it's a company, in my opinion. The electric grid tech is patent protected on all corners. Former engineers from big corporations have built it. Unique technology that shouldn't be easily duplicated due to these patent protections. I'm excited about that. No one should be coming in and trying to steal our idea easily. So we should have a lot of runway once we start selling it. We get ingrained to the system, and we are not only the first movers, but we're the stalwarts in this segment, which hopefully will prove very fruitful very soon and long into the future. Simpson Maxwell expansion in Canada happening along with D.A.T.A expansion could end up being the biggest benefit to shareholders in my opinion long term. If a company like D.A.T.A is moving into Canada and trying to expand, and we are toe to toe with them with Simpson Maxwell, that should be really beneficial to not only shareholders but everyone involved. And we have Gematria, Simpson Maxwell, and D.A.T.A will expand. 133 English reduction. Carbon capture being marketed through Simpson Maxwell, and I possibly believe Simpson Maxwell could be the first spinoff IPO shoe to drop. That could be years down the line, but they're already bringing in $46 million a year. If it's being marketed, the carbon capture is being marketed under Simpson Maxwell, that's only going to add to their asset value and revenue. And I think it could be a really good company standalone off of CEI. So that's why I'm holding CEI long term, because I would like those spin-off shares possibly. Oil still remains a part of the plans when deals make sense. That's what James said. Oil's not going anywhere. He understands that. But when the deal makes sense, he will add oil to the portfolio. In regards to illegal trading activity, it's still in the process. He can't say much due to it, but he hopes that, they do have a favorable outcome whenever it does, that shoe does drop. And hopefully, it starts trading naturally and organically where it should be without those naked shorts, illegal trading, and whatnot. So that's what we have on CEI, the James Doris interview, the valuations. Now let's get into the data cap dividend pack. And how it's going right now. Obviously, we could be officially in a recession here very soon, like when they officially call it a recession. So right now, the SPY, the SP and 500, it's been going down a lot. It's been retracing, but we still. That's what we're diversified in this dividend portfolio. When some things are up, some things are going to be down. When some things are down, some things are going to be up. And it's not even a month to month. Even though we track our profits and losses on a month to month basis, this is a long term, year to year type thing. And so, as I talked about on the intro, we're going to be going over ANDE. It's our best performing stock right now. It's sitting at $51. Our cost per share is at 37. We're up 36%, up $41. So that's good to see. Agriculture, always a good play when we go into recession downturns because people need to eat. Things still need to grow, and it's a safe place to be. And then we're going to talk about at the bottom here, real estate. It's a REIT, a monthly dividend company. But what's different is even though a lot of people are getting hit in real estate with these high interest rates, these are like lease single standing buildings like 7-Eleven, Walgreens, grocery stores, convenience stores, dollar stores. So they're a little bit different type of real estate. And a lot of the companies in their portfolio are still going to be around regardless of the situations that happen in America. And that's why I like it. And the monthly dividend is really nice. And so you see right now, our September 2023, this is our current month. We have 129 in the green, $129.88 in the green. We're down quite a bit right now at 195.79 on the red side. So we're only negative $65, almost $66. In the grand scheme of things, that being down $66, not a big deal. Again, that's why we're diversified. And when we keep we'll keep our eyes open for good deals. I've bought a lot more it's sitting at $51.65 right now. I have a 59 share price average, but I believe in the company long term. I believe in their business prospects, so I'll keep adding when it makes sense. I'm gonna keep adding when it's low because when it's lower, you get a better dividend payout. August 2023, that's the previous month. We were up $5. So we weren't up a lot, but we were up. So you see the waves right now of the market month to month. Again, they might officially call a recession. So we're just going to keep that in mind and, just stay the course, stay focused on what Data Productions Media got going on. Getting into Realty Income Corporation, stock ticker symbol O. Again, it's in real estate. It's a REIT, headquarters San Diego, California. The current monthly dividend yield is 5.68%. The PE ratio is at 40 times its earnings. A little high right now, but that's okay. Not every stock is going to be considered undervalued by their PE ratio. You're going to have to mold your perceptions in all unique ways. I really like this stock, and if it keeps going down lower, I'm going to keep adding to the position. And in regards to some of the Gematria we have O, real estate assets or quality equals 333 English ordinal and 396 in reverse ordinal. O, stock monthly paying dividend, also has 333 English ordinal with 396 reverse ordinal. So you see the connection here. O, real estate assets or quality. O, stock monthly paying dividend. You see that connection, right? We also have O, stock experiencing struggles even with an inverse real estate portfolio in 2023. That equals 330 in English reduction. We also have Realty Income Corporation stock equals 137 English reduction, which is the 33rd prime. So it has some really good gematria. All right. And understand, when the price is lower in the stock market, if you believe in the company, those are just discounts. Everyone, gets scared. Everyone thinks, the world's going to end. But if you know what you're buying, the discount is beneficial for when it goes back up, And at one point, it was trending at over $80. So if you believe in a company long term and it's sitting at 50 right now, that could be a $30 per share increase when the market turns around for real estate. And again, they're getting the residue, what's happening in residential real estate, not commercial or not even office, right? These are different standalone lease based things. It's not office space, not residential, and stuff like that. So this is like a different, unique blend, and I like it myself. Now, some more of the financials. Let's look real quick. The assets on hand that has 53.98 billion. The total liability is 22.67 billion. So the net equity is at 31.31 billion. The shares outstanding is 708.8 million. So I calculate the net equity fair value at 44.17. Now I'm not saying it's going to get to $44, but that's what the assets minus liability they have on hand for their fair value. So the closer they get to their fair value, the more closer of a discount I believe it is. So I really like this company, right? And here from the filings, I just have the percentage of the total portfolio of the things that they're in. So, obviously they would, when you think of, you think of 7-Elevens. So the convenience stores, right? From their last 10Q, we have June 30th, 2023, convenience stores, 11.1% of their portfolio. Grocery, 9.9%. Dollar stores, 7.1%. Home improvement, drugstores. So you see what their portfolio bases off of, right? But the top three that I really like to focus on: convenience stores, grocery, dollar stores. And so then when you go into client diversification and via their number of leases, you start getting into Dollar General, Walgreens, Dollar Tree, Family Dollar, 7-Eleven, FedEx, LA Fitness. So in other grocery stores like Tesco, Walmart. So this is their diversification. And a lot of these stores, even though in the down times they might not do too well, but a lot of these stores are well-run companies that they'll still pay their lease. All right, and that's what important. We have clients that continue to pay their lease. Now, in my opinion, the one the one client that I'm a little worried about right now is the Dollar Generals and the dollar stores in general, because they're losing a lot of money. A lot of people, those are in low income areas, and there's a lot of theft, and their margins are already low because they're selling low price products. So if there's theft still going on and they can't recoup that, that's going to be an issue. So hopefully, this can turn around, and I think that is going into the decrease of the stock price right now. But when there's blood in the water, you have to stand on what you believe in, and I think regardless if all the dollar stores go down in flames due to theft, we still have the Walgreens of the world. We still have the 7-Elevens, the Lifetime Fitnesses, the CVSs, the Lowe's, and whatnot to counteract that situation. And that's why they're diversified, and I think they're diversified in a really good way. For some gematria, we have dollar stores will affect O greatly, 137 English reduction. O is inverse REIT portfolio, 137 English reduction, 331 reverse ordinal. Retail, grocery, and convenience stores still pay rent during economic hardship, 333 English reduction. That's important. That's a big one. O is not exposed to office space, 303 in English ordinals, 33 because 0 is a value placeholder. So, that's my analyst on O, Realty Income Group, Incorporate, Realty Income Group. Just hold the line on it. It's a long-term play. a nice hefty dividend, and if it keeps going down in price, the dividend gets even more better. So that's what I believe. Now get into the Andersons Inc., ticker symbol ANDE, industry in agricultural, plants, renewables. Its headquarters in Maumee, Ohio. The dividend yield is a little low right now, but that's because it's been trending up, and we've been in it since 37 anyway. It's at 1.45%. The PE ratio is still at a nice point at 24 times its earnings, which I like. So it's again, this stock is our best performing stock in the portfolio right now. We've been in at 37. I've enjoyed it. I've understood that the recession has been coming, or we've been in one for a while, but they might now officially call it one. And so hopefully this one stays stable or keeps trending up. We're going to need fertilizer. We're going to need corn. We're going to need the renewables. We're going to need that type of agriculture energy even during downtimes to stay alive and stay afloat in America. That's not changing. And as you see, I have a little excerpt from the Bloomberg.com article. Agriculture stocks are beating their global peers this quarter as extreme weather, the war in Ukraine, and rising protectionism drive up food prices. Exposure to the sector is a good hedge for inflation, some investors say. This was August 19, 2023. We've been in this stock since March, early on in the year, because we had some foresight of what's going to come. All right, and that's why we're reaping the rewards right now. As you reap what you sow. Your land. We're getting that right now off that. Just for some gematria, we have agriculture and renewable stocks. 2023 equals 333 English ordinal. ANDE stock is a great recession play. 333 English ordinal. ANDE stock is 2023 AG for agricultural supply chain play, 333 English ordinal, and it also has 126 English reduction, with AND stock is a great recession play. Andersons Incorporated dividend stock, 133 in the Chaldean. Again, investment number. You just cast off that one. That's the 33 right there. Most agriculture and food companies survive recessions but grow slower during it, equals 331 in English reduction. So that's what we're working with the Andersons Inc. company. Very, very happy with it right now. I don't really plan on adding to the position due to its price right now. And, in stocks, your return is all what you pay for it. So it's been trending higher for a while. So I'm just going to stay on what I have. If it goes lower in price and it makes sense, I might add. But right now, I'm cool with what I got. 3 shares, collecting a little bit of a divvy. You got to stay diversified. So that's all right. Now, in regards to some of the financials of the company for the Andersons, assets on hand, they have 3.57 billion. The total liabilities is 2.3 billion. So that has their net equity at 1.44 billion. The shares outstanding, 33.5 million. So I have the net equity fair value at $42.98. So it's almost $10 above its fair value. But at that time when we were buying in March, it was below their fair value. So that's why we jumped in. And then going back to our long-term debt valuations, on hand right now, their long-term debt, again, they don't have to pay that in the current year, is 576 million, over $500,000. So I take the assets minus the current liabilities, minus the long-term debt. So I have 3.57 billion minus the 1.554 billion, which has a net equity of 2.016 billion. And so when I use the fair value minus the CLTLD, like we talked about earlier, their fair value is about $60.17. So there's still some meat on the bone to keep growing. And so I would love for it to hit $60. It might do it, because especially when people start rotating into safer plays, as they officially call the recession, which I do believe that's going to happen very soon. This was from an article, September, that just dropped. September, it dropped in 2022, from Michael Swanson, Wells Fargo chief agriculture economist. What would a recession mean for agriculture and food? Both agriculture and food manufacturing walk in economic parade of the U.S. economy, but they certainly march to the beat of a different drummer. As the economy measured by GDP grows, they both receive a boost over time. They don't grow as fast typically, nor do they ever really shrink. This is both good and bad news all wrapped together for the sectors. The good news is that if we do have a recession, mild or severe, then agriculture and food manufacturers will not see their top line revenue shrinking. The immediate caveat is that competition between different crops and foods can be intense during a recession as consumers look for better values. The bad news involves the long-term outlook the share of agriculture that has the share of agriculture and food manufacturing growing slower than the overall U.S. economy into the foreseeable future. ANDE, a grain play for 2023 recession, equals 137 in English Ordinal, the 33rd prime. So that's all I have for you guys today. Sorry about the live stream cutting out on us for some reason on Google Meet. I just paid for the whole year and I've used it like that in the past and I was on the call. I don't know why it wasn't working. But we'll figure it out for next month. It just like stocks, it's going to go up and down and we just got to figure things out. But if you got to the end, please subscribe to the channel, subscribe to all my other different channels, because we're always going to be working, we're always going to be grinding. But Art Turner, Data Productions Media, Dreams Are Tangible Aspirations, where we scheme our dreams into existence. I love you all, and I'll see you in the next video.